Good morning. This is Sakis Paraskevov, Senior Fundamental Analyst at IronFX, bringing you the morning comment for the 29th of July. Bank of Japan disappoints with only a modest stimulus dose. The Bank of Japan disappointed investors who expected an aggressive package of easy measures today by keeping both its benchmark interest rate and the target for its monetary base unchanged. The bank instead delivered only a modest stimulus dose by increasing its purchases of ETFs to an annual pace of 6 trillion yen from 3.3 previously. Given that these measures fell well short of market expectations, the Japanese yen strengthened on the decision and recovered some of this month's losses. Despite the considerable political pressure on the Bank of Japan to ease aggressively and supplement the government's anticipated fiscal stimulus, the officials appeared unwilling to step up to the plate. This may have been the case for a variety of reasons. First and foremost, it may be a sign that the bank is running out of policy ammunition, and therefore it prefers to save any possible bullets left in case of an unprecedented shock. Alternatively, it may be that the bank is facing technical difficulties in significantly expanding the size of its program and prefers to ease at a later time, something that hinted by Governor Kuroda, who ordered an evaluation of the Bank of Japan's policy effectiveness at the next policy meeting. Given today's underwhelming easing dose, we believe that JPY could remain resilient in the near term, perhaps until we see fresh speculation for further stimulus. Even though much will depend on the government's much-awaited fiscal package, we continue to believe that the Bank of Japan could ease further, mainly because of the further slide of Japan's core inflation rate into the negative territory. September's meeting is a likely candidate, as until then the government may issue longer-dated bonds for the bank to buy. As for today, Eurozone's preliminary CPI for July is due out, and the forecast is for both the headline and core rates to have remained unchanged. We view the risk around the forecast as skewed to the upside, considering the Germany CPI rate for the month rose above expectations, suggesting that a positive surprise in the block's print may be on the cards as well, and that could support the euro. Eurozone's preliminary GDP for Q2 is coming out as well, and expectations are for a slowdown. Later in the European trading session, the European Banking Authority will release the results of its latest stress test. The results will determine whether the European banks have sufficient capital buffers to withstand theoretical recessions in the European Union this year and the next, followed by a weak growth in 2018. In a break from past practice, the test has no pass or fail mark and won't specify capital shortfalls. Also, it is carried out on the basis of end 2015 data, which do not include the turmoil in the beginning of this year. In the absence of a pass mark, the CET1 ratios for banks under the adverse scenario will probably be the first thing for investors and analysts to look at. We believe that the Italian banks will gain extra attention mainly due to their large size of non-performing loans. Overall, the test is conducted in order for the authorities to restore confidence in the sector and preserve the much-needed financial stability, especially after the UK vote to leave the European Union. As such, the result of the test is likely to determine investors' near-term sentiment. From the US, we have the first estimate of Q2 GDP, and expectations are for growth to have skyrocketed to 2.6% from 1.1% quarter-on-quarter. We share that view, especially after retail sales for June rose more than expected and industrial production for the month recorded its biggest increase in 11 months. Further down the road, the stellar employment report from June diminished any concerns of a struggling labor market and confirmed that the May jobs growth was just an outlier in the overall uptrend. The forecast is also supported by the Atlanta Fed GDP Now model, which estimates that growth accelerated to 2.3% quarter-on-quarter. We also get the first estimate of the core PCE deflator for Q2, and expectations are for a slowdown. Even though diminishing price pressures could be seen as delaying the Fed from hiking, we believe that on balance, investors are likely to focus mainly on the potential sharp acceleration in GDP growth. The Chicago PMI and final University of Michigan Consumer Sentiment Index, both for July, are coming out as well. Overall, the strong data may support the greenback in the last trading day of the month. In Canada, the GDP data for May are coming out. As for the speakers, San Francisco Fed President John Williams speak during the day. For more information, including technical analysis, please read the full comment on IronFX.com or download our app and get all the information you need to trade. Also, you can follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google Plus to get more trading ideas. This is Sakis Paraskevov, Senior Fundamental Analyst at IronFX, wishing you solid trading.